how are we all doing? Welcome back to Can I Be a Stock Market Genius? I don't know what episode this is now, episode 6 maybe. It's been a little bit more time in between uploading videos than what I'd like. I had to move my office around and unfortunately that meant stripping down all my setup and my audio interface and everything. When I put it all back together, OBS had deleted or forgotten all my settings, and it was a bit of a clusterfuck to get everything back up and running again and getting it to the place that we are. So there might be some teething problems with this video, but we will see how it goes. Hopefully this sounds all right. I will listen back and we will see. It's probably going to end up getting uploaded anyway because it is what it is, unfortunately, but it will improve next time if that is the case. What I've been doing at the moment is playing around a little bit with some screeners that have been based off of Lee Lu's, what would you call it, masterclass? Was it a masterclass? He did a lesson at Bruce Greenblatts' class in Columbia, and it's return on deployed capital and operating margin and stuff like that. So he also stated that he used value line and constantly looked at the new lows, which is where a lot of his ideas came from. So I sort of tried to base a screener around that. A positive operating margin of above 5%, return on assets of above 5%. That's like tangible assets. So that's, I don't know, what would you, a semi proxy for return on deployed capital. But I've also added into the metrics that I've got here everything that would potentially be needed to come to a return on deployed capital like he does. Because if you watch the video, which is on YouTube, there's also a transcript that I found of it as well, actually, on this web page here. There it is there, that's the video. He talks about how he comes up with the return on deployed capital there, and effectively what he's doing is 275 million in working capital. Hang on, let me have a look. So he's looking at the liquid assets, which the working capital side of things, and adding that to the fixed assets, and then he's taking away cash, because cash isn't actually deployed. If it's held on the books, it's not deployed, it's not used for the running of the business. And then he's using the operating earnings against that and coming up with a return on deployed capital. So where does it explain it here? 200 million in liquid assets, around 100 million in fixed assets, so 300 million. But of the 200 million in liquid assets, 100 million is cash. So he's taken that away because it's not deployed. So you get roughly 200 million, and your returns are 110 million. There you go, in operating earnings. So, around 50%. So that's what he's doing. So what I've done is I've sort of put metrics on hand here, where you can come up with that. I've also got goodwill up here as well, so we can take that away from total assets. Unfortunately, intangible assets is not on the available columns that you can put in, but I've sort of set it up so we can have a quick look on there. Obviously, I've got this quick take spreadsheet, which I've shown before, which effectively does exactly the same thing. I put it in here, and then it will tell me return on capital. On this here is Joel Greenblatts' return on capital from his little book that beats the market. It's very, very similar actually to Lee Lu's return on deployed capital. I do that against simple free cash flow and against operating income. Obviously, operating income is unlevered, untaxed, and basically just the sole core earnings of the business. Simple free cash flow is the money, the actual cash that's available after everything. But yeah, we can try and work it out on here. That's why I've put it up here. Current assets minus current liabilities. It's not, specifically working capital. It depends how you define working capital. Some people would say that it is. Jesus, that isn't good though, is it? Current liabilities that much higher than current assets. I did look into the veracity of the data on this and seeing whether or not it's any good. Supposedly it's 95% accurate for this sort of thing, so obviously it's reasonably good enough to give you a ballpark figure. But yeah, current assets minus current liabilities, added to total assets minus cash and the goodwill, and then just off screen here the operating income. So quick return on deployed capital. Lilu stated that you've got to be able to say, figure this out within 5 minutes and then throw it away if it's dog shit. So I've sort of tried to lay it out in a way where you can work his formula for that return on deployed capital and then keep going. And I said the few metrics here: 52-week low, positive operating margin, and return on tangible assets of above 5%. I'm just playing around with things at the moment. You've got to do whatever you can to try and come up with, some investments to find. Like a lot of the time I would just use Open Insider, cluster buys, anything like that. Because I want to see insider buy and I want to know that the management are, at risk as well as you, because otherwise what's the point? If a manager doesn't have skin in the game, what's the point in him? I don't know why I highlighted that then. I'm just talking. It's like doodling on your pad when you're on the phone. What's the point in... I don't trust a management as much if they are not in it as well, because what's the risk to them? If the company fails, they just lose their job, they go and get another one, if they've got their own skin in the game and the company goes wrong, it hurts them too, and that's obviously not something that they want. So that is, something that I want to see. Just a side note as well, it's quite late now. Everybody in this house is in bed, so I'm talking a bit quiet on what I would like to. So it is what it is. I wouldn't normally... I'm semi-whispering at the moment. I probably don't need to be honest, because I'm shut away in a room, but it is what it is. So we've got a choice really. We can go down through the cluster buys, which is what we've been doing recently. We can just run down quickly through some of these and try and work out the return on deployed capitals here. I did see... This is what TradingView is quite good for, actually, is it gives you latest updates and all that. This doesn't look good. It's also not really the sort of business I believe that I would look into. Charter Communications lost 117,000 internet and 80,000 video customers. I don't even know what this business does at the moment, but it sounds like there's a investigation potentially pending a future lawsuit on this. So, this is a sort of place where you would find value, though. This is definitely a sort of place where you would find value when there's, bad results, potential for disruption within the business with things like lawsuits and all that. So I don't know, maybe this is something we could dig into, but at the moment, I don't really know. Let's just see what the business does. CHTR, Seeking Alpha. CHTR, Charter Communications. Where are we? What page does it say on? Here we go. Broadband connectivity cable operator company serving residential. So I wonder how many customers they have. Is 117,000 big? It must be, considering what's happened to the price. Is that a big loss? Let's get a new chat on here. That was just me asking some questions to ChatGPT regarding my future screener, or the screener I've just put together. Right, what are we doing? CHTR. What is the business tool for CHTR? Let's just put this in quick so we can charter communications, just so they know how do they make money, and what are the revenue breakdowns, should we say. See what they come back with. I just find that asking ChatGPT, even if it's not 100% accurate all the time, generally gets you a faster answer than trying to find it in all their company documentation. Operating under Spectrum brand, offers a range of subscription-based telecom and media services across the US. Okay, high-speed internet, cable TV, mobile services, voice services. Company drives value through bundling, internet, video, mobile, and voice, which helps reduce customer churn and increases average revenue per user. Okay. 43% is in the internet, so there's a lion's share of their business there, actually, which is a good reason, I would imagine, why losing 117,000 customers has hit the price hard. Additional context, internet brought in 5 billion, 5.8 billion, that's 2023, bit out of date, but strategic highlights. Internet remains the core of Charter's operations, contributing a large portion of revenue and serving as a foundation for upselling other services. Looking forward, actively pursuing scale and synergy through a major merger with Cox Communications valued at 35 billion. So what's the market cap on this? But that's going to be both companies, I suppose. Do intend to expand customer reach, improve negotiating power, and unlock about 500 million in annual cost savings within 3 years. Business model: subscription-based telecom. Breakdown: it dominated by internet. Trends: internet growth remains strong. Does it? When you've lost 117,000, I'm guessing that was a surprise, considering. Earnings surprise to the downside. Would you like deeper insights? Yeah, I would. What are their internet, what would we say, subscription numbers? Would it be subscription? On the internet, yeah, we'll just use that word because I don't really know how else to. Subscription service numbers, or customer numbers, let's say. If they can actually give us an idea, we'll know whether or not 117,000 is big. 29 million, okay. This marks a decline, of 117,000 subscribers in the second quarter of 2025. Ongoing decline, now shed a total of close to 1 million over a 7-quarter period. Okay, compared to 2020, yes. So it's not as bad as what it was. It's certainly going in the wrong direction, isn't it? Let's just put it in this quick take spreadsheet a minute, see if it comes up. CHTR, that's right, isn't it? Yeah. I mean, on market cap, look at that. You will find that in telecommunications businesses that there is a lot of debt. Generally, they're very, what would you call it? Equipment heavy businesses. So current cash flows, operating income, take 2.6 years to buy the market cap, but the enterprise value is a completely different story. Look, 35, what did I say? 35 million, it's billion. 35 billion in a market cap. And 129 billion in enterprise value, which means the debt must be quite high. I've got total debt on here somewhere. 100 billion. Does that tie in with that? Yeah, it does. 100 billion, wow. Okay. Probably not keen on this already, just from the debt load. Can we find any of their debt? Charter Communications. Okay. Oh, alright. What's going on there? Oh, 2009. Jesus. Majority date. No wonder why you can't find that. Are these all Charter Communications? There's a lot. All of them's around par though, so nobody's overly concerned by the debt. Some down here mine for the 60s, but then look at this. That's a way away. Way away, that is. What have I got here? SECCHTR. Let's get a 10Q up and read it and see. This is me once again not throwing away stuff fast enough, isn't it? Because that debt is huge. It should just be out of it. See you later. When's the maturity date? Does it say, is there a breakdown? Total debt. No, is it just going to give you that, is it? Literally. Literally nothing telling you when it matures. Just has a summary. I don't like that. We're going to actually try and sack things off faster because, you know, I'm sure I could find it. I'm sure they would have to put it somewhere. It's just going to take us back up there again, see? Alright, screw it. We're done with this one. I'm not going to waste my time looking into that. There's another huge sell-off. What's the news on this? Wix's earnings. What's ACN then? What do they do? ACN. I can, well, to be fair, I can just put this in a quick take spreadsheet and it'll tell me instead of having to do this. This has taken probably longer. Oh, God. Software, data, AI. I know that there's a lot of excitement around that, but I don't understand the business. I don't understand this either. Look, what's that? COVID? Yeah. All right, next one. LKQ. LKQ. All right. Hang on, wrong one. LKQ. What do these people do? Distributes replacement parts, components. Okay, what's that? Automotive? Yeah. Operates in 3 segments. North America. Company distributes bumper covers, automotive body panels, lights, as well as automotive glass products, windshields. Okay, this is a company that I understand as an engineer. You know, well, I have the ability to understand, let's put it that way. Generally, I believe as well, parts companies are not great businesses, but enterprise value of 13 billion, market cap of 7, operating income of 1 billion, so it's not too bad. What was the chart doing? Tanking, absolutely tanking. Okay. Never ever got above there, look. Tried 3 times, 4 times, one, what? We'll call that once because it's around about the same time period. 2, 3, had enough. Where are we going to go now then? Where's a potential technical analysis floor? Either around about where we are. Don't know why I'm doing this once again. Technical analysis. Not true value investor. See, that's what people say. Okay. Right. Let's have a look. What can we do about this business? Where am I there? Let's shut them down. Alright, sack this one off. New chat. What's this business called? LKQ. What is the business model for LKQ? How do they make money? And what is their revenue breakdown? Let's see. Like, kind, and quality. Operates global provider of alternative and specialty automotive parts, systems, and accessories. Core offerings include replacement parts. Okay, we knew it anyway. Generate revenue primarily through wholesale distribution of replacement parts to repairers and service facilities, specialty parts and accessories, hard to find components, self-service, salvage yards where customers pick up and pay for used parts. Okay. Services like refurbishment, sourcing, their expansion and growth strategies, heavily acquisitions. Here we go. A lot of goodwill on this book then, I would imagine. Is that on here? Yeah, 5 billion. Jesus, what's the tangible book value minus... I don't like that generally. I don't like negative tangible book at all. Goodwill 5 billion when the market cap's only... Oh, sorry, when the tangible book is... I don't know, I don't like that. I don't like intangibles or, you know, intangibles, some of them I can get my head around, you know. There is definite value in brand names and stuff like that, you know. The goodwill is very rarely does it actually pay off, you know, in my experience from what I've seen so far. A lot of goodwill generally is not something I like. Revenue breakdown, parts and services account for 95% of total revenues. Remaining 5% comes from scrap metal, precious metal, cores. Okay. Oh, sorry, just smashed the microphone then. I got it in a different position than normal, sort of more in front of my face. So when I move my hands around, I'm going to have to get used to not hitting it. Reports across 4 segments. Okay. So what's this? For the quarter, is it? I don't know, for the full year ended. So Europe is their biggest, well, not just 700 million. Europe is their biggest area. Recent performance trends, shrinking everywhere, all across the board. Revenue split, so yeah, Europe is just the biggest. Okay. Bottom line, LKQ's core focus on distributing parts services for vehicle repair. Parts and services dominate revenue, account for 95% of all sales. Okay. I tell you what, I don't have my sheet handy to me on what I wrote. Let me see if I can just get Microsoft Word opened up and bring it up on another screen. Because I updated it all, didn't I? I had a load of questions to follow. Here we go. Right. Understand the business and the business model, where revenues come from, breakdown of revenues, are they contractual, recurring, or seasonal? Let's have a look. That's a good question. Are revenues contractual? Was it contractual, recurring, or seasonal? See if it tells us that. They do have recurring elements, mostly no for contractual. working in this sort of industry, I'd imagine they just buy as they need. That's what happens in our industry anyway. When we need parts on the railways, they don't buy it unless they need it. So there's nothing really contractual about it other than we're going to use you at some point. Demand for replacement parts is structurally recurring because vehicles can. Yeah, okay, I get that. Not really what I meant, but yes, okay. Seasonal, yes. Often stronger in North America due to more collisions in winter weather. Q2, Q3, spring sale. Fewer accidents. Hang on. So why would Europe, who also have harsh winters, or can have harsh winters, that's interesting, spring, summer. Maybe we just drive less around here in the winter, I don't know. Transaction based with recurring customer relationships, yeah, okay. Does the company have any forward guidance? Yeah, I'm on. Yes. So they're expecting earnings growth. Are they adjusted earnings guidance? No, sorry, not growth, sorry. Completely reading that wrong. It's been revised down. Following a weaker than expected quarter, full year EPS guidance was reduced to $3 to $3.33. So that's, not a revenue decline, 1.5 to 3.5%. It does have forward guidance and it doesn't look good. Okay. Are we wasting our time on this one again? What did it say on the quick take? LKQ. I don't like the goodwill, to be honest. Do we drag it in here? Just have a quick look. Don't know what I've had up here actually before. Delete. What was it? LKQ. Just to see. I think we're wasting time really. LKQ Corporation, NASDAQ quarterly, because that's what I do. Don't know why it keeps doing this. I don't like. If anybody knows, ever since I've updated to Windows 11, my Excel, my Word or whatever, it doesn't like any of this, and I keep getting these bloody notices. EAC, right. Back to the copying and pasting of the highest professional order. Nope. Go and have a look at the balance sheet. Current, non-current, goodwill and intangibles is 7 billion of the 10. Total current liabilities, we do have enough to cover it. Long-term debt, 5.6 billion. What's the total debt? Where's the short-term? 289 million. Just have a quick look on the main metrics, but there's not really a lot that I like. Gross margin is pretty consistent in it. What I need to do, what I'm going to do actually, is turn all these into 3-year averages. I know once again that would seem like it is stealing from Roaring Kitty spreadsheet again, but it just, I've been reading a lot into it, and it appears a lot of people will do like 3-year averages because it smooths out, one extraordinary year or anything like that. So going forwards, I will probably do that at some point. Operating margin shrunk quite a bit from the, that's probably I don't know, is it a COVID hangover? Because Yes, people would have bought more parts. I don't know, actually. What's their distribution thing? We haven't actually looked into that, have we? What is their... Is their distribution model? Do they have their own shops, or... What's the distribution model? Do they have their own premises, or do people just buy parts from them? They own and operate a large physical network rather than acting purely as an online marketplace. Own and lease distribution centres. Operates hundreds of regional hubs. Okay. Self-service yards. Interesting. I mean, I haven't heard of any of these. I haven't heard of LKQ, but majority of sales are B2B. What's B2B? What is B2B? Let's Google that instead of using it one of our questions. B2B sales. Business to business. First to pro. Okay. See, shows my experience. Ain't got a clue what a lot of the acronyms are. I had to Google them. Large hubs hold deep inventory, smaller satellite branches, receive replenishments to keep service local. Okay. Field sales maintain ongoing relationships, call centers, online ordering portals, customer flow, inventory on its own premises. Okay, salvage bottom line is not just a virtual middleman. They physically own or lease the warehouses, yards, and hubs that hold their inventory and use their own logistics fleets for distribution. So they don't manufacture then. I've probably read that and not conned on. They don't manufacture parts. Their business is distribution and supply rather than production. They source parts from, genuine parts made by the manufacturers. Okay. All right. What were we doing other than wasting our time on this? Because I don't like it. I don't think already. Yes, it's trading at almost half of revenues. It's very asset heavy, which is obviously good. Simple free cash flow margins dropped. Gross margin is reasonably consistent. Sales are dropping slightly, although that's a 12.5% increase there. Interest expense. So they're saying the return on capitals are good. 20%. I just don't like the balance sheet. Where are we? That tangible book. It was positive for a period. Historically always been negative. What's goodwill done over the years? Only grown. No, that doesn't mean that the companies they bought are worth more. It just means they could have bought more and more companies. It's not really something I like, to be honest. I just don't like the goodwill being that high. Negative tangible book puts me off. If you want like a liquidation value proxy, tangible book, I suppose, is technically it, because you can't really sell intangibles to someone, can you? Brand names, I suppose, not like you could, but nah, don't like it. We're going to move on from that one. Problem is, I can't remember where we were looking now. Were we on this? Yes, we were. Right. Technology services again. Salt systems aren't the Dassault French weapons manufacturer. Dast. DASTF, I'm sure. No results found. I'm sure Dassault is their bloody fighter jet. The Raphael was Dassault in it. Dassault system software, yeah, something to do with it, but look, it looks like they got the same. French multinational software corporation, okay. Is it something to do with it? I would imagine it is, yeah. Software used to develop 7 out of every 10 new aeroplanes in the 90s. That's pretty good, isn't it? Interesting. 2022 present. 2020 present. Sorry, big sigh there. It's going to come up on the microphone. Aren't they the same company? Industry CAD-CAM. So aviation, there it is. Yeah, it's very similar. Is it? I don't know. So look. Salt Aviation and Salt Systems are related but distinct companies within the broader Dassault group. Okay, yeah. So look. Salt Systems initially spin off from Dassault Aviation, created to the market the software for the aerospace company. Interesting. Although they're going to announce on the SEC, they're not going to be Paris in it. Yeah, nothing there. Makes it a bit harder to look up. I don't even know what their Wikipedia. What is there? DSY. DSY. There we go. $27. Yeah, that's the thing. That a depository receipt or something. DASTF. DAST former. I don't know. What is it? DSY. Is that right? DSYA. Let's see what comes up on here. DSYA. It's identical, so another one there. What's the difference here then? Prices are just mirroring it, doing exactly the same thing. Interesting. The market cap. Current assets minus current liabilities. Jesus, there's a lot of cash mine. 4.8 billion of 7 billion is cash. That is interesting. What's going on here then? What's the news? AI competition, I see. Operating margin of 30%. That is high. 2021. I mean, COVID was down here. It's almost a double back to the highs, but couldn't get back to the highs. Don't really know. Right. Let's ask what the business model is then. New chat. What is Assault Systems? We can spell it in English. Business model. How do they make money? We've sort of answered that already. And what is their revenue breakdown? Right, what's he going to come up with? Thinking. Print software company specializing in 3D design, digital mock-up, and product. Okay. So that isn't technology? Not like it used to be when they said that 7 out of 10. When was that? Where did I read that? Was I just skipping through too quick? Sure it said in the 90s. Oh, cars, not aeroplanes. I don't know, 7 out of 10 are new aeroplanes. Used to develop. Okay. Design and mock up their products. What do they do then? Business model centers around providing a unified platform, 3D experience, integrates design, simulation, manufacturing, collaboration tools. Okay. The company has increasingly shifted towards a subscription-based model, enhancing recurring revenues. Okay, we're going to need more of a business segments, comprehensive suite of product design, life cycle management, cloud-based. I don't know if I'm going to understand this. In which case, I'm just going to sack it off. And you explain what they do as if you were talking to a toddler. What do in layman's terms, is that I spell? I don't know. They make powerful software that helps companies design and build things like cars, airplanes, and even... Oh, I see. It's like CAD software then, is it? Imagine you want to build a new car instead of building physical prototypes right away. Software to create a super detailed 3D model of the car on your computer. Yes, CAD. You can test how it looks, moves. Okay. Software also helps teams work together. Interesting. It's like a... Sounds like it's like a... advanced CAD type thing. Computer-aided design. Okay, that makes more sense. That makes a lot more sense to me. I should have read it there. I'm qualified in CAD. Not that I'm very good at it, and I haven't done it since my apprenticeship, but... Right. So what I'm going to do... It's getting quite late here now, so... We might pick this one up tomorrow. I'll just keep this in the same video and we'll do a welcome back in the morning. And go with it from that point of view. Okay. Yes, the business model makes more sense to me now. The only problem is how am I going to draw that data, and it's going to be in euros. What is the... Is it DASY? Nope. DSY. I've looked at this one before. Yeah, euros. What's the current exchange rate? Euro USD 117. €1 is 117, okay. Okay. So let's go back up to here then. Software sales include licenses, subscription, and maintenance fees. Okay. Interesting. Is there a breakdown? We can probably find that. We can't do it on here though, can we? This is where ChatGPT is going to try and come in handy. Is there a break of their new locations? Come on. Detailed breakdown of its software region, revenue by region, according to America's 10% year-over-year growth. Wow. That's interesting because I would have thought a French company would have been bigger in Europe than in America, but interesting. Do I open these? No. Oh, it does. I didn't think it had a key. Interesting. Can I get the data in my spreadsheet is the next question. The DSY come up here. What it has to be, it's going to have a prefix on it. Prefix, not prefix. One that comes after. So look, DSY. Not that way. Dassault Systems. Oh, they've got the same one that's on TradingView. Interesting. F. That is interesting. What's their... Surely their primary market is France. If it's DSY. Yeah. What's former as well? Is Dast still on that stack? No symbol. Was it Dast F? Yeah, it is. Okay. So yes, I can draw it in. Just chuck in the quick take spreadsheet quickly. Dast F. Your revenues are nowhere near big enough to buy the company fast, let's put it that way. Return on capital is supposedly huge. Which I'm guessing it would be, I suppose. Makes sense, doesn't it, if it's just a software company. Own a couple buildings and then everything else is just pure returns. What have we got on here? What? Balance sheet. Quarterly, latest one. Sorry, just scratching my eye. Tangible book value of just over $1 million. PP&E under $1 million, yeah. Typical software company then. Current assets, where's current liabilities? I mean, we looked at this, didn't we? It's more than covered by the cash. Hang on then, let's just try and do graphic calculator. Keep smacking the microphone. 7.19 minus 3.93. What is the total assets? Plus 16.98 minus the 5.5 in goodwill. Then we've got to take cash out, haven't we? It's not deployed. Minus 4.81 and 9.8 billion. in deployed capital. $5.5 divided by 9.88, 15% return on deployed capital. If I've just done that correct. It's not bad. But the operating income for the cost of the business, you know, not really sure how it got up this high. Anyway, I said I was going for a little bit just now, so I will catch you again in the morning, but for you, I will catch you again in a second. I was just looking quickly then. I hadn't done that right, had I? Because I did total assets, but I'd need to take the current assets away from that. And then the goodwill, according to Joel Greenblatts' calculation. Now, the deployed capital, I got a funny feeling he's only talking about possibly the PP&E and 100 million in fixed assets. Large amount of inventory. This is the transcript a minute of working capital previous results, transcript of the Lilu's Bruce Greenwald lecture. That's where we're at. See, does he mention fixed assets any other times? Wow, these fixed assets are buildings and real estate, decent protection on the downside. So yeah, he's going to be on about PP&E, I would imagine, in which case my doofer's wrong, my thing here is wrong. I need to take total assets away and put maybe PP&E in. Fixed assets. It's cheap, and we have to do deep finding in the books, figure out what fixed assets are. What classes as fixed assets then? So learning together here. Tangible property or equipment a company uses for PP&E. Right. Copy and paste this. Let's put it in here. Where's my last? Oh bugger. My last conversation. There we go. About Lilu. During this lecture, Lou mentions fixed assets when calculating his return on deployed capital. Is he talking property, plant and equipment? I'm guessing he is, or total assets. See, this isn't going to know for certain, right? But it's just going to give me more of an idea. He's specifically talking about property, plant and equipment, not total assets. Okay, fixed assets, property, plant and equipment. So my calculation was wrong. Is wrong on the, what's it called, the advisors excluding goodwill, business trader out, clean book value consistently, mostly tangible liquid assets, working capital plus 100 million in real estate. Here the 100 million real estate refers to PP&E, which is part of the deployed capital. Okay, fixed assets specifically refers to PP&E. Can I get that on here? I'll try and sort that out for the morning because I haven't actually gone to bed yet. Got it on here? Probably not. It's going to be a bugger. Oh, that's going to ruin doing that. Okay. Unless we did some sort of hybrid between Joel Greenblatts, total asset, net fixed assets, total assets minus current assets, and goodwill and intangibles. Maybe I haven't got the intangibles on there, but I could just do total assets minus current assets and goodwill. It's a ballpark to get it dragged into the main spreadsheet, really. But that is annoying. Financials. Cash flow, where's it on? Balance sheet here. They haven't got it. That is a bugger. We're going to have to do a hybrid then, really. If I cannot get up the property, plant and equipment. And they've got I'm sure they've got financials on TradingView somewhere. Anyway, I'll figure it out. We'll get back to it in the morning. Now I know that that's wrong. I'll try and fix it before I continue on with this. Or like I said, I think I'm just going to have to do total assets minus current assets minus the goodwill. Let's just do a quick thing of what that would actually be. 7.19 minus 3.93 plus 16.98 minus 5.55 minus 7.19. So you've got 7.5 billion left in deployed capital. In which case, mind, the return's going to be huge now. 1.55 divided by 7.5. 20%, 20.6%. Do that again. Make sure 7.19 minus 3.93. Okay. Add that to total assets, 16.98. Now we got to take away 5.55 because it's goodwill. Take away the cash. I didn't take away the cash last time, did I? 4.8. Now 7.19. This is going to be a good business. That's left with 2.69. What was it? 1.55 divided by 2.69. High return on capital business, 57% on return. This is graphic calculator stuff here. You can't see me doing it. 57% on return on deployed capital. Not that we can use property, plant and equipment, but we can do like a hybrid of this. Interesting. All right. We might dig into this a bit in the morning, possibly for a little bit. Its earnings are still not great though. On a EV to EBIT, EBIT to EV scale, EBIT to simple free cash flow to enterprise value, market cap. It's not the best business, but all right. Leave it at that for now, and this time I will see you again in a minute. All right, welcome back. Probably going to be a difference in the vocal sound in this video halfway through, because obviously it's daytime now, so I can speak a little bit louder than what I was last night. We left it with looking at Dassault systems. I was going to drag them into here, which is what I've already done, into the main spreadsheet. I got to be honest, I don't really... Yeah, the return on capital is amazing. But when we go down to the multiples down here, there's no, real difference in you know, in the multiple analysis, at some point, obviously during COVID, it went nuts and traded at 60 times earnings, operating earnings, that is. I mean, you know, 70 times earnings, 60 times earnings, that's a lot, you know. Has the market now just completely reevaluated? Look, when we've gone, what's the average over the last few years? 33. Have they completely reevaluated how they now view this company? What was revenues doing back then, growing consistently every year? Wow. Gross margin was in the 80s. What is it now? Still in the 80s. So it was a good business, you know. It still is a good business, but multiple wise, wow, you know, it seems that they've potentially adjusted how they view it. I wouldn't want to pay 30 times earnings, you know, for anything personally. Other revenues a share obviously all gone up, I'm guessing, because yeah, this one here, very little has changed as well in the number of shares outstanding. It's slowly grown over the years. Free cash flow margin has stayed around about the same. Everything has stayed reasonably consistent all the way throughout this business. So the only thing that's really changed, I'm guessing, is that everyone's just decided that 70, 80 times multiple is just too much now, you know. It doesn't, I said, I don't want to pay 30 times earnings for something. I think that is absolutely ridiculous. 2021, what was it in 2021 when we hit those highs down here? 50 times earnings. It was more in line, I suppose, back then with the historic average, but nah, not for me. It just seems like everybody has changed their potential. Still very, you know, in line. There's nothing hugely different here over the last few years, other than potentially people's changed the way they view the company. You know, 30 times earnings is nuts to me. So I think we're just gonna pass on this one. I don't see anything here that's worth me looking into purely on that multiple basis. It's just not something that I want to pay that much for, you know. Yeah, the simple free cash flow margin's good. The enterprise value's pretty good, but yeah, what we got there? Simple free cash flow share $1. Oh, what am I doing there? $1. It ain't for me. It's not for me. Yes, the return on capital's good. Where's it gone? On the bottom here. Don't know, just waffling on now about how many different ways I can say I'm not interested. So we just go straight back again. That, oh, this same again, exactly the same company. Salt Systems, not sure why. Maybe they've got two different types of share, but there's two different listings. Price is very much the same. Not even going to bother looking into that. Not interested in that. There's not enough data. Not interested in that. There's not enough data. Look at this for a growth. Go daddy. Wow, that is huge growth. What happened there? I mean, it's coming down as well, mine. Don't catch a falling knife, but let's have a look. What are the operating income? $1 billion. What's the market cap? 19 billion. Okay. Get the old graphic calculator out again and we'll do the hybrid because I can't get PP&E up on there. I think I can get it up on an indicator here. It's just how accurate it is. Maybe we can check that. indicators, financials, balance sheet. Property, plant and equipment, net property, plant and equipment, gross property, plant and equipment. What's the difference? I'm guessing the amortization difference between net PP. Where's the and? Used to using a Apple, and now I've changed. What is this? Not interested. Represents the original historical cost of the company's long-term assets, while net PP is the gross less accumulated depreciation. There you go. What would Lee Lu use? Let's go back to this one here. Would Lee Lu, well, not that this knows, but it's just give an idea, be using gross or net PPE? We'd most certainly be using net, yeah, because I think that's all that's on when we go into here, because it's referenced in the balance sheet. I can't even see PP&E on there at the moment. And the other one further up here. PP&E on here, net profit, appreciation. Can't see it. What have we got here? Current position, long-term debt. I'm not really sure I'd read this because this isn't something that I've ever seen other than in this. I can't see it. I can't see property, plant and equipment. He talks about it though. He talks about the assets. I don't know. We'll I like to spend time breaking down what other people have done because I find it very helpful, but I'll do that off stream as opposed to on. I can't see PP&E on here. Common stock includes A and B shares. So you got depreciation there. I would have thought it would have been on here. I can't even see total assets, but there's a good chance I'm just being blind. Anyway, they're saying he's using net, so in Columbia Lecture, he treats fixed assets as part of book value. I'm thinking about deployed capital. Book value always records PP&E net depreciation. Yeah, so that's why I believed it would be net. So if that's the case, let's put this on here. Let's get rid of some of these a minute. Price to sales system. I got these on here just so I can price to sales ratios, price to free. I mean, I could keep it on here, I suppose. Is it going to give me a proper figure? Oh, it is. If I net PP&E 197 million, just so I don't have to. Can I try and use that across that? Let's see. Oh, they're using a negative working capital, which makes that harder to do current assets, current liabilities, or that. Either that or they're in financial difficulty. Where is this one? Quick take spreadsheet. What's the GDDY? Keep punching the microphone. I'm gonna have to get used to where it is. Billion in simple free cash flow, 57% return on all regards to operating income, 81% there, and simple free cash flow. Historically, very good. Simple free cash flow has grown. Revenues have grown. What has caused that huge spike there then? Because look at this, for the longest time it was trading in and around this area. How long did it spend in there? Like once it broke into this above $60, it spent 5 years stuck in that price range, and now all of a sudden, what caused that? Is it just earnings? 22% surprise, and then everyone's gone nuts over it, maybe. Oh. Let's have a look. Should we just pull it in the spreadsheet and have a look instead of guessing? Let's try and... I know of GoDaddy because I used to watch a lot of NASCAR back in the day, and they sponsored Danica Patrick. New chat. Let's see. Explain. Go. I can't remember what they do. Insurance or something like that. Business model. How they earn money and the revenue breakdowns. Thing question we always really start with. Let's see what they come up with. Domain, that's it, it's not insurance, domain registrations, that's right. Typically pays a small fee and domain and charges customers a markup. Okay, GoDaddy offers website hosting, email hosting, website builders. Okay, didn't know about that. Applications and commerce tools, reseller, network and subsidiaries. Includes a Wix style. Okay. Website building tool. Also generates revenue via reseller programs and through customer acquired via acquisitions and partnerships. So what are they, acquisition heavy, are they? And try generally tell that by the level of goodwill, 3.6 billion of total assets. So close to half is in goodwill, which not really something I generally get on board with. I can close that one. All right, let's continue reading. Q3 2024, core platform, modest single-digit growth, significant double-digit growth in this. Applications and commerce, that's the website building, marketing services, okay. 4% revenues up. Core platform includes domains, hosting, basic services. Still the largest bucket in absolute terms. Overall, GoDaddy aims to be a one-stop shop for small micro businesses, helping with naming presence. Okay. Primary revenue sources, domain-related services, hosting and security, increasingly value-added web and commercial tools, strategic shift, growing emphasis on higher margin, scalable services like A&C tools, financial trend. Core business remains steady. A&C is the engine of growth, fueling both top-line revenue and profitability gains. Would you like a deeper dive on margins, customer counts, or growing emphasis on higher margin? Explain the higher margin. What was it? A and C. I'm even looking now. There we go. A and C. Tools business. Higher margin growth engine. Here's why. A&C segment bundles together all of GoDaddy's software-based value-added services that go beyond simply selling a domain. These include the website builder, online store creation, marketplace selling. Okay, productivity apps, branded emails, email marketing campaigns. Okay. Why is it higher margin? Mostly software, low cost to deliver another copy of the service after it's built. Infrastructure costs scale well. Recurring subscriptions, customers often keep paying monthly or yearly predictable incomes. Often upsold alongside domain registration, hosting, creating customer lifetime value. Once a business builds its site, email systems, and store on GoDaddy's platform, moving is a hassle. That is true. Value-based pricing, unlike domains where the wholesale cost is fixed and price competition is fierce. That is true. I don't know for certain, but I have built a website before on a similar sort of system like this. It wasn't Wix, it was a different one. Once you've built a website, you can't, you're sort of trapped in it, you know. Not if you're someone like a huge company like this. I'm sure moving wouldn't be too much hassle for them, but I would never have thought about doing it just for the hassle. Scale and performance brought in 400, it grew much faster, yeah. Gross margins for ANC are significantly higher than for core platform because core domain includes domains, low markup, yeah. Okay, in essence, ANC businesses where GoDaddy captures premium scalable revenue, turning domain buyers into long-term subscribers who pay for tools to actually run and grow their businesses. So when did the ANC side? Because if it's in line, bearing fruit, I don't really know how to ask this question. I'm just wondering if it's in line with the huge expansion of the price. Mid 2023, early signs of strong growth, surge 11% year on year. When was this? 2024. Yeah, there you go. 2023. Boom, gone. What's causing the price drop now? Their earnings missed considerably. What have we got here? GoDaddy is maintained a buy by Citigroup. Okay. Yeah, mid 2023, earnings came out. Surprised everyone. I'm guessing probably maybe because of this ANC thing, and it just went to the moon. Everybody's piled in at that point, though. Potentially taking it to the point of overvalued. Look, because even price is still dropping, even though they've had big surprises again and again. They have one downturn where everyone's realised, oh, hang on a minute, this is probably a bit too overvalued. Earnings surprise positive, earnings surprise positive, and price is still falling off a cliff. All right, let's have a brief look, because it's good to keep an eye on companies. I've got a tracker as well, which maybe I can put a few things in. Just so you can have a quick look. Where are we? What do I want? This one here. What was the ticker? GDDY. Okay, where are we at here? Delete. GDDY. Is it going to come up or not? What is going on here? Go. It's not even changing now, look. It is. GoDaddy, come on. Why would it find that? There it is. Don't know, sometimes it's a bit strange. Error while searching for symbols. What's going on there then? Has it brought everything in? Looks like it still dragged it all in. Right. Excuse me. Right. And we haven't got the price in. Let's go back one page. Up on here. GDDY. Book value a share $1. Tangible book value minus 31. Straight away, that's me like not too keen. Cash minus debt minus $22. So they obviously got a significant amount of debt. Let's have a look at the balance sheet. Total liabilities 7.6 billion. Total assets 7.8. Current assets are 6 billion, of which 4.6 are goodwill and intangibles. Although, what's its simple free cash flow? The actual value, $1 billion. very difficult, isn't it? This is where my limited understanding of goodwill and all that really sort of affects my ability to make an informed decision. Generally, I don't like it because generally, from my experience so far, goodwill almost always gets written down. But then if you're earning $1 billion in earnings, you know, in simple free cash flow, wherever it was down here, EBIT's also $1 billion. What's their total debt? $3 billion. I mean, they could pay off the debt within 3 years if that was sustainable. What was the simple free cash flow last year? 7, 6. I mean, what's this? Post-COVID? Yeah. One bad year, but look at this for growth in simple free cash flow. From around about 400 million to over $1 billion in 4 years. Gross margin, bad last year. Well, not bad, it's still good, but it's, you know, 6-7% drop. Regained it again this year. Interestingly, cut costs. Operating margin increased. Simple free cash flow margin increased massively. Is there going to be a one-time gain in that? Because that is a 6% leap is significant. Get up the SEC filing and find out if there's a one-time gain in that. SEC GDDY. Go on this one. I normally like going on the full one, but statement of cash flows. Where are we? Net cash provided by investing, so we are there. Operating, where is it? Net cash provided by operating activities. I wasn't the right one, I was just reading the wrong bloody line. 6 months. What then? Has anything significantly changed? Really boost that? I mean, it doesn't look like they've paid any payables this year. It's all positive, look, whereas last year some of these were negative. What's this one? Gain on loss of derivative instruments. No, that's the one below again. I'm not reading. How am I not reading this right? Look. There, deferred taxes. 44 in. Doesn't look like there's anything. Am I missing something? Do they have? They must have. They must have bonds, I would imagine, surely. No results to show. GDDY. Who do they owe their debt to then? Let's bring up the actual thing. Go down through it. Goodwill and intangible assets. What's they got in here? Indefinite lived intangible assets. Domain portfolio. Okay. See how there's value to that. Customer related. What's this? Doesn't even define what it is. Interesting. Develop technology. Trade names and others. Okay. Goodwill. Here we go. It doesn't say. Not really broken down. Long-term debt. Let's have a look at this. Notes, yeah. 2029, 6% notes. Maturity date 2029, 2027. What are they under them? Why can't I find them? Body. Go daddy. can't find their notes. Where can I find Go Addy's bond? Is it bonds? I don't know. Gonna be in it for notes. They listed under then. When they're not on FINRA. GDDY. Have we got the ability? I don't know if we've got the. You must be able to, I'd imagine. I don't use this enough to figure out. I don't know if you are going to be able to find it on here. No, I don't know. I might be looking. A thought popped into my head then, but I'm not sure if it's actually something I can do on Yahoo. All right. I mean, where are we? They've got $1 billion in free cash flow. I don't think they're going to struggle to pay off that in 4 years' time. You know, I don't think the debt currently is anything to worry about. When have they ever had a free cash flow negative? Not in the last. Which one was it? That one? Yeah. Never. Right. Okay, so the debts, I don't think the debt's anything to worry about, not with the earnings that they've got. Multiples here, look, 50, 100 times. Wow. I can never get my head around why people would be willing to pay that much for something. Seems a bit ludicrous to me. What's going on here? Why is there no 45? Where's 45? Simple free cash. Oh, I tell you why, because I deleted the cell. What's that done against? Against market cap. Okay, so that's that then. F54. That's because I deleted something out of the spreadsheet 18 times. I mean, that's less than half of what it was back there. The business is doing better, the margins are doing better, but is there any forward guidance? Let's just have a look at my questions, what I need to ask. What are the quality of the current assets? Let's have a look. We didn't really spend much time on the balance sheet, actually. Pardon me. Balance sheet. Cash and equivalents, $1 billion. That's what I mean. The debt's not a problem, is it? If you've got $1 billion in cash on the books. Current portion of long-term debt's only 15 million. Deferred revenue. Okay. Long-term debt. Net of current portion. Where is their property, plant and equipment? 148 million. Operating leases. GM really care about them for reasons I've explained in earlier videos. It appears I don't like the goodwill. I've said that a couple of times. Don't really like the intangible assets. Said that a couple of times, but you know, it's pretty good, doesn't it? So what's the debt. Total current liabilities 3 billion. What's this one here? Deferred revenue. Okay, so deferred revenue, I believe, is just products they've sold that they've not yet delivered. So long term. So it's really, I mean, the deferred revenue has increased actually. Is there any deferred revenue? The increase in deferred revenue is primarily driven by payments received in advance of satisfying our performance obligations, offset by 673 million and 1.5 billion revenue recognized during the 3 and 6 months of June 2025 that was included in the deferred revenue balance. Aggregate remaining performance obligations that we recognize as revenue over the period in which performance obligations are expected to be satisfied. Okay. How do they accumulate deferred revenue then? What do they do that accumulates? What do they do that accumulates deferred revenue? Is it just people paying for like 2 or 3 years worth of a website, and then obviously there's that left to go? Most of its products are sold as subscriptions paid in advance, but the accounting rules require them to recognize revenue over the period of services delivered. Yeah, that's exactly what I thought. All right. This is a bit of a difficult one, isn't it? Because this is a significant sell-off. I mean, where is that going to come down to, you know? But the business looks reasonably solid. What is anybody else saying on it? GDDY. Hold, sell. Clicking on growth, but a domain. On valuation multiples. Fully valued. None of these have really got any comments on them though. Overvalued ahead of Q4 earnings as competitive edge falters. Let's see. GoDaddy will announce its earnings on February the 13th. Analysts expect 144 in earnings per share and 1.8 in revenue. 1.18 billion in revenue, representing solid year-over-year, quarter-over-quarter growth. 39% driven by successful AI service products and speculation on future growth despite competitive pressures. Similar valuations and revenue trends. GoDaddy's growth is threatened by potentially superior AI tools from emerging competitors. Okay. Neutral on stock because it faces competitive pressures. I appreciate 39% pushing up the stock, a staggering 88% year on year and 185% since its bull market trend began at the end of 2023. Yeah. Much of GoDaddy's recent success is attributable to the proven results of its AI service products and significant speculation regarding the future potential of the growth opportunity. Yeah, Wix may have an edge on AI on GoDaddy. Interesting. GoDaddy is a well-established internet company with long-term market dominance and profitability track record. It does. We've seen that. However, its transition toward website creation and management tools through AI is new. Okay. Hence the increase in price on that front. It is younger than Shopify and Wix, as GoDaddy has invested more heavily in AI tools. Shopify is where I built a website. Its stock has skyrocketed in value. However, its revenue growth is rather lackluster in comparison to... Okay. Shopify boasts annual sales around 8.2 billion, surpassing GoDaddy around 2021. GoDaddy has TTM sales of 4.5 billion, while Wix is around 1.7 billion. Of the three, Shopify has the most incredible track record with immense growth over the other two. However, Shopify's business model differs in that it is more specific to e-commerce, generally costs much more, and is comparatively less DIY approach to e-commerce website development. GoDaddy is historically the most DIY focused, although that is changing with its new tools, while Wix is between the two and has tools for both e-commerce and other website types. From a valuation and fundamental trend standpoint, GoDaddy and Wix are similar, trading at similar valuations with closer revenue trends. At the same time, Shopify has more growth but trades at a price of sales of 18x and a very high forward PE of 93. Forward price of sales and price to earnings of both companies are very close. where does he go on about why he thinks it's going to... Google Trend Search data is a more speculative tool that could give us an insight into relative performance of either company in the industry. GoDaddy is likely overvalued as edge faulters. Here we go. Let's get into the crux of why I read the article. Two primary segments, core platforms and applications and commerce, which is more comparable to Wix. Yeah, that's what we've read earlier. Challenge of assessing GoDaddy's future is the importance of its legacy versus the value it offers to customers. GoDaddy is a dominant web company in the 2000s. GoDaddy is one of the most well-known companies in the industry, but that does not make it the best. Its core services are slightly more expensive, while its web development AI tool is slightly inferior to Wix, Squarespace, and WordPress. In the long run, I suspect that GoDaddy may lose its brand name value, with Wix or others potentially gaining more market share. It's worth noting that GoDaddy's operating margins are extremely high compared to Wix and Shopify. That said, GoDaddy's debt is also higher, with its liabilities amounting to 21% of its enterprise value compared to 15%. It's reasonably overvalued today. Wix has had greater growth in sales. This is what I need to get the comps part of my spreadsheet back up and running, isn't it? Get that going again so I can whack these in, because at the moment I haven't got that ability. Bottom line, although I still believe the e-commerce and web development industry is oversaturated and that slower economic activity may cause the industry's prospects to temporarily reverse, yes, especially if business in the long term is faltering and it gets more expensive to get into, less people's going to be interested in purchase, like in becoming new customers or that sort of thing. I suspect GoDaddy will see erosion in its market share. Its revenue and income will likely continue to rise over the coming years. I believe GoDaddy is materially overvalued today, but there are limited immediate catalysts for reversal. Okay. All right. So what I need to do here then is I need to compare it to others, in which case I need to focus on the comps part of my spreadsheet, which is something I said I needed to do for a little while. So maybe I'll finish this video here and I'll crack on with doing that. And then next time when we come back, I'll have the ability to do the comps. We've gone for a few businesses today anyway, haven't we? Learned a bit more, which is obviously the whole point of this whole vlogging series. All right, we'll leave it at that. I'm going to go away and do my spreadsheet and we'll see what happens. All right, thank you very much for watching and I'll see you next time. Goodbye.